Hey YouTube, I wanted to make a quick video for you to talk about inflation because I see a lot of things that talk about the cause of inflation and blame inflation on different things, and they talk about the government, talk about corporations, individuals, and those things are not things that necessarily cause inflation. So if you understand the cause of inflation, you can not only see when inflation started, who decided it, and how they decided it, but you can also see at the beginning of inflation, you can see how it's going to play out over time just based on that decision. So let's get into this real quick. All right, inflation is increasing the money supply, which decreases the value of each dollar, for instance. The value of the Roman currency right now is nothing. They inflated it to zero, and the eventual value of every currency is zero in the world. It's just a matter of time. Now, who creates inflation? Only one entity can print money, and that is the government. So anything else where they talk about corporations or price raises and things like that, those are all effects of the government's decision to print money. So if you go back and you look 3 years ago, for instance, and you say, what is the change in the U.S. money supply? Not what caused the change. That change will eventually be reflected in the price of things that you pay for. Now, how long it takes to actualize that change depends on some factors. So let's get into this so you understand when inflation is going to occur and maybe what some investment moves you can make to not only deal with inflation but to profit from inflation. So number one, causes of inflation. Money printing. They print money by printing dollars. They print money by issuing debt. They print money by buying corporate debt with the U.S. Treasury. FDIC can create money. There's lots of different government or, para-government organizations that can create money. But the government is the only place where inflation is created, okay? Because inflation, by definition, is changing the value of the money. Now, what are the effects of inflation? Now, the first effects of inflation, as you saw, was wage increases. It happened from the very bottom hourly wage people first, in this case, and then it trickles up and actually gets larger as the person's skill sets get more in demand and more needed. Like, if it costs your company $1 million, if you leave, they're going to be able to spend more money to keep you than a company that maybe it costs them $20 an hour for you to leave, right? And that's just a fact of the value of the time and what you're putting into it. So you have wage increases and demand increases happen instantaneously. So the demand increases mean people have more money from these wage increases because there's more money out there, right? Well, how did more money get out there? Well, they printed the money. So the money is out there, and it is in the people because there's no place else for it to go. And so there's a demand increase. Now, secondary effects that people often get confused about are property tax increases happen because the value of your real estate holds its value over time, and those taxes increase because the values increase. You have insurance increases because the cost of the labor and the things, as we saw, increase. These are secondary effects. The rent increases. Now, I had to increase rents because the schools charged more property taxes, and the insurance companies went up in wages. Now, for just insurance, I wouldn't have had to increase it, but the property taxes went up to pay for schools. Schools didn't say, I don't need that money. They took the 10%, and that increased your rent. Costs increase, happen after this because of demand. And interest rates increases can happen because there's more money out there, and the people lending it have to account for inflation, degrading that debt, unless it's the government lending. So right now there's a lot of government lending, but individuals have to charge more when inflation is in play, because if they charge you 5%, inflation is 3%, they make a net 2% on your risk. If they charge you currently like 7% inflation and they charge you 4%, then they're making a -3 plus the risk, so maybe -5% all the money they lend. That's why it's the government actually lending the money. not causes. Corporations are not causes of inflation. They can't be. They're not the government. They can't print money. They can't control the value of money. Only the government controls the value of the money. Now, short term, they can raise or lower prices. That's true. But long term, that's not actually how it happens. Individuals can't cause inflation. They're not the government. They can't print money. Understand that helps you track back to what decision was made to cause inflation. So let's say inflation was created in January 2020. The government created inflation. Well, these other things are going to play out over the next couple of years. If you know what's going to play out, then you know how to allocate your money. You know how to look at job things. You know how to what to buy now, what to buy later, how much to save. You know, you're making debt decisions, purchase decisions, investment decisions. So things that help inflation, and sometimes these are confused by part of inflation or an offset to inflation, but inflation is just printing the money. But capital markets help inflation by creating competition. Things are done more efficiently. Allocation of capital is done by those most skilled to allocate capital because they get more money as they handle it well. Competition decreases prices over time without inflation. Efficiency advances help technology. You just think of the cost of pop or milk when we were kids. It has gone down since the last 20 years. I mean, I think pop was a $1 or $2 liter when I was a kid, and you can still get it for that sometimes on sale or close to that, which means that it's actually gone way down in price compared to other things that you buy. Investments. So the thing about investments you have to understand is there is a net effect on investments. Some investments are bad to have, some investments are good to have, and some are kind of neutral to hold your value. So real estate, the net effect of real estate, how long it takes for inflation to happen depends on the length of the contract. So if you look at what they were talking about in the news, they talked about the money was printed and it wasn't affecting rents. And they talked about that for about 6 to 9 months until, rents started going sky high. Well, what happens is on a rent, you have like a 12-month contract. And so I'm not raising rents because I have a contract with those people. But on about a 12-year cycle, I start getting hit with taxes on the properties going up. I have to raise rents. Or at about 6 months, some of the new contracts come up, so rents start going up. So they're saying, hey, there's no effect on inflation on rents. Well, they just didn't understand the cycle of rents for personal rental houses, for instance. Because you're going to have a 12-month cycle there, and then your rents are going to go sky high. On commercial properties, depending on the type of property it is, if it's a local business, like a local restaurant, they may have a 1 to 5 year, maybe a 3-year contract that prohibits large increases until that contract's out. So maybe 18 months you'll start seeing local restaurants really jack up prices really high because their rent doubled. You look at something like a Cane's or a Chipotle or those things, they will have like a 5-year contract with 3 different renewals at a controlled rent rate, maybe of a 5% increase. So they may not get hit with massive inflation on their rent for 10 years, and so that's not reflected in their food until that hits. Stocks, if your stock is of a company that's positively affected by or positively or neutrally affected by inflation, then your stock can hold its value. If you're at a company that is a very, very hard competition with no competitive advantage, then you won't necessarily fare well. So a utility company that possibly can increase rates as the price of energy increases and gets paid a percent of the rates might do fine. A monopoly like Apple might do fine. Although with Apple, there's an effect of debt and cash on the company. So cash goes down in value, and debt, makes you money. So a cash-heavy company might have a problem with inflation being high. Crypto, they talk about crypto not being correlated to the NASDAQ, but I think people sell out of crypto to buy stocks and vice versa, and so they have kind of a corollary effect sometimes, and sometimes they don't, so that one's hard to predict. And savings and cash. If you have savings in the bank or cash in a savings account, you're guaranteed to lose money. That's not a risk. It's a surety. You may not see it, but if you have $1,000 in the bank, in the last year, you're losing 7%, maybe $70. You have $10,000, you're losing $700. You didn't see it, but it didn't make it unreal. And so, the reason I'm kind of making this video for you is, if you understand, number one, the cause of inflation versus the effects, you can see exactly what's going to happen. Like, beginning of 2020, they increased the money supply by 1/3. All of these things are going to happen after that. They're going to happen. They always happen. And so knowing that helps you look at your investments and say, well, maybe I should have more debt. Maybe I should have less debt. Maybe I should have more cash or less cash. Maybe I should shift my things from a stock that's going to be affected negatively by inflation, maybe into real estate or something different that's going to be positively affected by real estate. And so understanding those, you can actually be in a situation where you're not afraid of inflation. You're actually making money because inflation exists. And that's where you want to be, is where a situation happens and you can make money because of that situation, where everybody else is scared of inflation and you're not. You're making 2 or 3 different moves, and now you're making $10,000 a year in addition because inflation exists. When everybody else is really worried about their salaries and their incomes and being able to keep up with that. So I hope you enjoyed this video, talking about what inflation is, what causes it, what the effects are, and like and subscribe if you want more. And if you have ideas for videos you want to understand better, put those in the description down below, and I'll talk to you later.